and investors struggle between bonds versus equities. The outlook for bond yields in 2025 is mixed and depends on several factors, including the new administration's policies around tariffs. While some analysts expect bond yields to remain volatile but within a defined range, others believe that yields could decline if the Federal Reserve continues to cut interest rates. The impact of tariffs on bond yields can put investors between a rock and a hard spot. Historically, tariffs have led to increased market volatility and higher inflation expectations, which can keep pressure on rising yield rates. However, if tariffs slow economic growth, this could lead to lower yields as investors seek more profitable returns. As this is likely the case, a volatile short-term boost followed by a market pullback in the latter part of 2025 can weigh on the minds of investors. Changes in bond yields and tariffs can lead to significant impacts on both investments and the broader market. Here's a breakdown of how these factors could play out. Impact on investments.
Rising yields.
If bond yields continue to rise, the prices of existing bonds will fall, which can negatively affect bond portfolios. However, new bonds will offer higher yields, making them more attractive to investors with money on the sidelines.
Interest rate risk.
Investors might benefit from taking on more interest rate risk by investing in bonds with longer maturities, especially if the Federal Reserve continues to cut rates to get to a neutral rate position.
With corporate bonds.
With the Fed in easing mode, corporate credit and other securitized products might outperform treasuries and equities, persuading investors to secure positions in corporate bonds rather than the stock market. Stock market impact.
Higher borrowing costs.
When costs rising bond yields can lead to higher borrowing costs for companies, potentially reducing their profitability and affecting stock prices through their bottom line.
Sector impact.
Sectors like utilities and real estate, which are sensitive to interest rates, might see more volatility. Conversely, financials could reap benefits from higher treasury yields.
Impact on the broader market. Tariffs. The introduction of new tariffs can lead to higher consumer prices and disrupt supply chains, which would slow down economic growth. However, tariffs can also protect domestic industries and potentially boost local production, causing a short-term boost in the economy. Inflation. Tariffs can be inflationary, as they increase the cost of imported goods to consumers. This could lead to higher overall inflation, affecting consumer spending and a reason for the Federal Reserve to pause or increase the federal funds rate. Market volatility. Both rising bond yields and new tariffs introduce uncertainty into the stock market's future, which can lead to increased volatility. Lower-risk investors usually migrate to safer assets, such as high-quality bonds, during these periods of heightened uncertainty. Global trade. Tariffs can strain trade relations between countries, potentially leading to retaliatory measures and further impacting global trade dynamics. This can affect multinational companies and sectors reliant on international trade, increasing prices on products offered by these companies to clients and consumers. Overall, the interplay between bond yields, tariffs, and broader economic policies will shape the investment landscape in 2025. It's essential to stay informed and consider diversifying your portfolio to manage risks effectively. The bond market in 2025 is expected to be influenced by a combination of tariffs impacting economic growth, inflation trends, and the Federal Reserve's monetary policy, which has been revised recently by Powell. 2 less rate cuts for the first part of 2025.